It all started with a price tag. James is scrolling through a stock app on his phone, waiting in line for coffee, half paying attention, when one price tag stops his thumb completely. Not a price on a car, a price on the whole company. One car company on the screen is worth more than several of the biggest car companies on Earth combined. Not slightly more, not a little ahead. More than all of them stacked together, added up, totaled. He looks up from his phone at the parking lot outside. He counts the cars in 30 seconds without really trying. A Ford, another Ford, a Toyota, a Honda, a Toyota again. Then, finally, one of the cars this headline is actually about. 1 out of 8. That's the part that snags him. If this company is worth more than a group of automakers combined, shouldn't its cars be everywhere? Shouldn't it be outselling everyone, flooding every road, dominating every driveway? Instead, James just watched an entire parking lot fill up with almost every brand except the one the whole financial world seems obsessed with. So today's business file opens with a question that sounds simple and isn't. How can a car company be worth more than a group of rival car companies combined, while selling noticeably fewer cars than some of them? Before we open this file any further, hit like, drop a comment with your first guess, and subscribe with notifications on, because the answer to this one changes how you'll look at every big stock price for the rest of your life. Here's the mystery in its full, strange shape. In the spring of 2026, this company's total stock market value sat above $1.4 trillion. That single number was larger than the combined value of several major automakers people have trusted for generations. Companies that build millions more vehicles a year, in dozens more countries, with factories that have been running since before this company existed. And in that same stretch of months, one of those older, less valuable companies actually sold more vehicles in a single quarter than the trillion-dollar company did. Think about what that means for a second. Somewhere, an investor is looking at two companies. One sells more cars. One is worth dramatically more money. If you only looked at one number, units sold, you'd think you had the wrong company entirely. James starts wondering if maybe the whole idea of a car company doesn't apply here the way everyone assumes. But that thought only raises another question. If this isn't really about cars, what exactly are people buying when they buy this stock? To understand that, you have to go back to a much smaller, much shakier version of this story. A startup most people assumed would fail. This company began in 2003, founded not by an auto industry veteran, but by a small group of Silicon Valley engineers who believed electric cars didn't have to be slow, ugly, or apologetic. For years, that belief looked closer to wishful thinking than strategy. Its first product was a low-volume electric sports car built partly on a sports car chassis, sold in the low thousands, expensive to build, and barely profitable to sell. The company nearly ran out of money more than once in its first decade. On at least one occasion, it survived only because outside funding and a last-minute deal arrived within days of running dry. Then came a shift that mattered more than any single car model. The decision to build not just vehicles, but the entire ecosystem around them. Its own network of fast chargers, its own direct-to-consumer sales approach instead of dealerships, its own battery and software expertise kept in-house rather than outsourced to suppliers, the way almost every traditional automaker had done for a century. A mass-market sedan arrived in the mid-2010s and became the company's first real high-volume success, followed by a compact SUV that would go on to be one of the best-selling vehicles of any kind, gas or electric, in the entire world in certain years. Along the way, the company built its own massive battery and vehicle plants, enormous factories in the Nevada desert and later in Shanghai, built specifically to manufacture batteries in cars at a scale no startup automaker had ever attempted before. It also grew a second, quieter business selling large batteries to homes, businesses, and power grids for storing electricity, layered on top of the vehicles most people associate with its name. By the early 2020s, this once fragile startup wasn't just surviving. It was the most valuable automaker on the planet, and it had been for years. That's an incredible turnaround story on its own, but it's not actually the mystery this file is about. The real mystery starts right where that success story seems to run out of road. Because by 2026, the easy, obvious version of this company's growth story had clearly slowed down. Competition had caught up in ways that would have seemed unthinkable a decade earlier. A major Chinese electric vehicle maker was now selling more electric cars globally in raw volume than this company was. Legacy automakers that had been mocked for years as slow-moving dinosaurs had shipped their own capable electric and hybrid vehicles, chipping away at what once looked like an unshakable lead. And in one recent quarter, this company posted one of its weakest sales performances in years. A period so soft that a well-known American automaker, selling traditional gas-powered trucks and SUVs, actually delivered noticeably more vehicles worldwide in that same 3-month stretch. Quick pause here. If you're the kind of person who likes guessing ahead of the reveal, drop your theory in the comments right now. Then share this with the one friend who always has an opinion about this company's stock. You'll want to see if you called it. If you were grading this company only as a car manufacturer, using the same yardstick you'd use for any other automaker, units built, units sold, year-over-year growth, the picture in 2026 looked shaky at best. Softening deliveries, fiercer competition, a shrinking lead in its home market compared to just a couple of years earlier. Any traditional auto analyst reading only those numbers might reasonably expect the stock to be sliding, not soaring. And yet the stock market kept doing the opposite. The company's total value held above well over $1 trillion, at times exceeding the combined value of a dozen other publicly traded automakers, including household names that build and sell several times as many vehicles worldwide every single year. Toyota alone, the largest automaker in the world by production volume, was worth only a fraction of this company's value, despite manufacturing millions more vehicles annually across a global network built over more than 70 years, with factories, suppliers, and dealerships spanning nearly every country on Earth. By almost any traditional measure, factories operated, vehicles produced, countries served, decades in business, Toyota should win this comparison easily. On the stock market, it wasn't close, and Toyota wasn't winning. James sits with that contradiction for a moment, turning it over the way you'd turn over a puzzle piece that clearly doesn't belong to this puzzle. More competitors, softer sales, a quarter where a rival literally built and sold more cars. And still, the market was pricing this company as if it were worth more than an entire alliance of automakers stacked on top of each other. Something here isn't measuring what everyone assumes it's measuring. Here's a clue that starts to crack it open. When professional investors and analysts talk about this company's future, the conversation almost never centers on how many sedans or SUVs it expects to sell next year. It centers on a handful of things that have nothing to do with the showroom floor at all. A fleet of self-driving taxis the company is racing to deploy in American cities. A humanoid robot designed to eventually work factory floors and warehouses instead of people. And a driving assistance software subscription that turns every vehicle already on the road into a potential future revenue stream, long after the car itself has been paid for. Notice what's happening in that sentence. None of those three things are cars. They're built using the company's cars, sold alongside its cars, tested inside its cars. But the actual value investors are pricing in isn't how many vehicles rolled off the line this quarter. It's a bet on whether robots can work jobs, whether taxis can drive themselves reliably at scale, and whether software already installed in millions of vehicles can eventually be sold and resold like a subscription, the way you'd pay monthly for streaming or software rather than buying a single physical product once. If you're starting to see where this is going, hang on just a little longer, because there's one more piece that ties this whole thing together, and it's the piece that finally makes the numbers make sense. Picture two completely different businesses hiding inside the same company. Business number one is the one everyone can see and touch. Factories, assembly lines, steel, batteries, and finished vehicles rolling out the door to real customers. That business faces exactly the same brutal, competitive, thin margin pressures every other automaker on Earth faces. Rising material costs, price wars, slowing demand in certain markets, rivals catching up fast. Judged purely on that business, this company looks like an ordinary, occasionally struggling automaker, which is exactly what the softer sales quarters were showing. Business number two is almost invisible on a factory tour, because you can't point a camera at it the way you can point one at an assembly line. It's the promise that this company's self-driving software could eventually operate paid robotaxi fleets in dozens of cities, competing directly with existing autonomous ride services. It's the promise that a humanoid robot, still in early development, could someday be mass-produced and effectively sold or leased as a form of labor, the same way you'd staff a warehouse, except the worker never needs a break, a wage increase, or a shift schedule. It's the idea that a driving assistance subscription already sitting inside a huge existing fleet of vehicles could become a recurring software revenue stream on top of the one-time sale of the car itself. And here's the moment everything clicks into place. Investors haven't been pricing this stock like a car company that happens to also work on some interesting side projects. They've been pricing it like a technology and robotics company that happens to sell cars as its current, visible product line, while quietly betting its real future value on things that haven't fully arrived yet. That's why comparing cars sold to a legacy automaker was always the wrong yardstick from the very start. You were never actually looking at two companies competing in the same category. You were looking at an automaker and something closer to a very ambitious, very unproven technology company, wearing an automaker's factory as its current disguise. That single realization is why the softer sales quarter didn't crater the stock the way it would have for almost any other automaker. Weaker car sales barely dent a valuation that was never fully built on car sales in the first place. It's also why the comparison that started this whole file, worth more than several big automakers combined, yet selling fewer cars than one of them, stops sounding contradictory the moment you realize the market simply isn't grading this company on the same test. Here's the business lesson underneath all of it, and it applies far beyond $1 trillion stock ticker. Markets rarely price a company for what it is making and selling today. They price it for what investors believe it's becoming. A neighborhood coffee shop that only sells coffee gets valued like a coffee shop. But the moment people start believing that shop is quietly building a loyalty app, a delivery network, and a licensing deal with grocery stores, its perceived value can leap far ahead of its actual coffee sales. Because now you're not buying today's cups sold, you're buying tomorrow's entire ecosystem. The same logic explains why a small local bakery that starts licensing its recipes to grocery store chains can suddenly be worth many times what its ovens and countertops would ever suggest. Because now investors aren't buying loaves of bread, they're buying a licensing business wearing a bakery's apron. The product on the shelf and the product being valued aren't always the same thing. Quick reminder before we close today's file. If this changed how you'll read a stock price the next time you see one, tap that like button. Leave a comment telling us which company you think is hiding a second business like this one, and turn on notifications so you don't miss the next file the moment it drops. This company was never really being valued as a car company. It was being valued as a bet on robots, software, and self-driving fleets that hadn't fully arrived yet, with an automaker attached almost as a down payment. File closed. James closes the yellow folder slowly, glancing one more time at that parking lot full of ordinary cars. He's not thinking about how many vehicles anyone sold last quarter anymore. He's thinking about how often a price tag on anything, a stock, a product, even a small local business, is really a story about where someone believes it's headed, not a receipt for where it already is. That's the kind of question that doesn't stay closed once you've asked it. You start noticing it everywhere, in your own investments, in the companies you follow, even in the businesses down your own street. The dry cleaner that's quietly become a pickup hub for 3 delivery apps, the gym that makes more from its supplement shelf than its memberships, the local restaurant whose real profit engine turned out to be catering, not the dining room. Once you learn to ask what a business is really becoming, you can't unsee it anywhere. Before you go, make sure you're subscribed and sharing this with anyone who's ever looked at a stock price and thought, that makes no sense. Because today's lesson is exactly why it sometimes does. Drop a comment below and tell us what you think this company's stock is really betting on 5 years from now. We'll be reading every guess. And speaking of businesses that aren't quite what they appear to be, next week's business file opens with a product almost everyone in America has bought at least once, from a company that, on paper, should be losing money every single time you buy it. Somehow, it isn't. We'll find out why. See you in the next file.